Good morning, everybody, and welcome to our webinar about FinTech Angel Investing, everything you need to know. And our goal today is to cover this very interesting topic for any new investors who want to join an angel network such as FinTech Circle and who want to understand better how to invest in unlisted companies, in startups, what to look out for as an investor, how to choose startups, and how to work with other investors, fellow investors, potentially in syndicates, but also especially for UK investors, what the tax benefits are, which protect the downside for investors, but have still unlimited upside. So those are the key topics for today. So welcome to all of you and welcome to all of our potential new investors who want to learn more about investing in startups. It will be a very lively, very engaging session. So you've got on the right side the opportunity to ask us any questions you've got as part of the Q&A session. So even during the time when we speak, please feel free to type your questions in. We will come back to them at the end of our conversation. And for our conversation, we'll in a second invite my panel members to join me. But just first of all, a quick introduction of myself. So my name is Suzanne Chisti. I'm the CEO and founder of FinTech Circle. I am an angel investor myself. So I invested in about 10 FinTech companies so far, both business to consumer and business to business FinTech companies, and had already 2 exits already. So very lucky that we chose the right companies and backed the right founders. And so I will share also war stories and explain from my own experience how investing works. We also have got a whole panel members with us who will share their experience and their thoughts with you in a moment. And FinTech Circle, we run an investor network for FinTech founders to raise funding for FinTech investors to choose the best FinTech deals as well. So we can also talk about that as part of the Q&A. And our next FinTech investor network takes place next week, in fact. So for those of you who want to invest in FinTech startups, you can apply to become a FinTech investor on our website, which is fintechcircle.com, where you can join and become a FinTech investor to apply for it and then you will get an invitation for our private investor network, which takes place next week in the UK, but we also do this a few times a year. And at the moment, everything is virtual, of course, which basically means our investor network is open to FinTech investors globally who want to join to invest in FinTech startups. So this is just a quick introduction on FinTech Circle and on myself. Now I would like to invite my panel members to join me, and I will hand over to all of them so that they can introduce themselves to you because we chose them very wisely. They have got the expertise both in investing and also in the legal and tax space, which is so important, especially from a UK investor point of view, where great tax schemes exist to mobilize the investor base in the UK to back FinTech and general startup investors and startup investments as well. So if I can ask Malika, Deborah, and Gordon to join me now on this panel discussion. And what I would love to do now is to hand over to each of you to introduce yourself first. So if I can start out, please, with Deborah.
Hi, I'm Deborah Angel. I'm a partner in Deloitte Legal's corporate team. I act on both sides of the table when it comes to investments. So I work with owner managers on their fundraisings and also for investors when they're making their investments into companies. And what that really means is that I draft and negotiate the investment agreement and the company's articles. I have a number of fintech clients, and I've also acted for a number of clients who have made investments in the fintech sector.
Fantastic, Deborah. Thank you. Now handing over to Malika.
Thank you for inviting me again, Suzanne. I'm always so pleased and privileged to be part of the FinTech Circle group of investors. My name is Malika Poldraj. I'm the author of a book on investing called How the Best Invest, make confident decisions like the investing superstars. I worked for many years in Silicon Valley. I was a technologist, and I worked in London City and in Wall Street in various different roles, very much on the research side. I'm on the Stanford Angels Network selection committee. And basically, over the years, I met many entrepreneurs, many investors, and I found that people have this problem of making haphazard decisions when it came to investing. They have this perceived there's someone else has the secrets, they don't have it, and the whole thing just became too hard. So I've tried to come up with a very systematic approach towards investing money and how to access the best investors, and in a very easy to understand manner. And I'm glad to be here. Thank you.
Fantastic, Malika. Thank you. And Gordon.
Hi there. My name is Gordon Rowell. I'm an associate director in Deloitte's tax department. Basically, I specialize in advising entrepreneurial private clients. So basically, that means I advise them at all stages of the business cycle, and specifically get involved with startups advising on CDIS and EIS schemes. Like Deborah, we advise on both sides. We advise the investors on the great tax reliefs that are available, and we also advise the companies on how to qualify for those tax reliefs.
Fantastic, Gordon. That's great. Thank you so much for joining me today. And we've got such a great audience, and you're a great panel member. So I'm looking forward now to, first of all, ask our audience a few questions. So we will now share the polling questions to get to know you better and to see the experience we have got among our attendees today. So the first question which pops up in front of you now is, have you ever invested in a startup before? So either say yes or no, and just press the submit button, please. And then we will see the results coming up here with us. So far the response is about 60% have invested in a startup before, about 40% not yet. So new interested potentially to learn to invest into startups now. So that's excellent. Now the second poll comes up in front of you. Have you used SEIS or EIS tax reliefs for any previous investments? There are three potential responses. Yes. Yes, you have used SEIS, EIS, or no, you have invested before, but you have not used those tax benefits. Could be of various reasons. Could be because you invest outside of the UK. Could be because you invest in companies where those do not apply. Or the third option is, no, I've not invested in startups yet. So just again, choose your response and say submit. And again, we can see the results here coming up. So we see about 26%, almost 30% have used SEIS, EIS tax reliefs so far for previous investments. We have got about 36% of investors who have invested in companies but have not used those benefits yet. And then we've got about the 40% of investors who have not invested yet in startups, and therefore also have not been used those benefits yet. So that's really helpful. Thank you so much to all of you for responding to this poll. So now I would like to start out with, first of all, an overview, because as an investor, my background is I worked for Morgan Stanley Asset Management many years ago, and our high net worth investors, of course, have lots of choice, lots of options, and there are lots of choices where you can invest your money in, and especially now post-pandemic, it's very important to make the right decisions, for investors. So I would like to come to Malika first and to ask you about this choice, because as we know, angel investing, is one form of investing, but you could also invest in listed equity, in bonds, in properties. And so why is it important for an investor to think about his or her strategic asset allocation before investing?
So the number one rule of investing is to try not to lose your money, because that's what preserves capital in the long term. At the same time, if you just hold a pool of money with inflation, it'll deplete over time. So you have to balance those two things. And asset managers in general have a quarterly approach towards investing. They want to do well in this quarter or this year. But if you look at the larger pension funds and sovereign wealth funds and university endowments, they have a longer horizon. So what I try and do is get people to look at what the longer horizon people are doing, because if you're 40 or 60 or 35, your horizon is several decades, and you probably want to leave some money to your children or your grandchildren or your favorite charities. So our individuals, our horizon is usually a couple of decades. So in my book, I've illustrate something called ice cream sundae investing, which is basically if you take your child out to have an ice cream sundae, you will not give them a bowl of chocolate sauce or a bowl of sprinkles. You have to have a balanced one, a balanced ice cream sundae that it can be yours, it can be personalized. So what I would suggest is a scoop of bland vanilla bonds, because those give returns and the risk of you losing your money is not very high. Then a scoop of chocolate equities, which is obviously you can lose your money, but mostly publicly listed equities are they do have cash flows that back up their share price usually. And then you could have strawberry real estate. And so you start with those building blocks, and after that you add your toppings, which could be angel investing and hedge fund investing and cryptocurrency if you want to. And I think if you look at the really big, powerful investors, you'll suddenly see like, oh, Paul Tudor Jones invested in cryptocurrencies, will make headlines. But if you go look at his actual portfolio, it was 1% of his portfolio he put into crypto, not 10 or 90 or 100. So just to keep that in proportion. And Suzanne, we spoke before about, on average, how much should a high net worth or a ultra high net worth put into venture and angel? And we both said the number should be about 10%. And what I see is a lot of zeros and hundreds. Like people will put most of their money into venture and angel, or they'll put nothing. They're too risk averse. So somewhere in the middle, I guess 10, 20%, depending on who you are. And there is no perfect number. If you look at all the pension funds and university endowments, these are people who have all the information in the world on investing, and yet their proportions will differ. So Stanford might put 22% of its money into venture and private equity, and Yale might put its like 7%. And so everyone's just making bets based on the valuations and information they have. So you should too.
Yes, very thoughtful, Malika, response. And that it comes back to this thing we all learned, in childhood, never put all your eggs in one basket, so diversify. A key thing is for investing as well. So very important to only put a small portion, of your investment into private companies. And like you said, so it's interesting to see. So Yale, it's about less than 10, but then you've got Stanford putting 22%. So it's between 10 and 20, but it's everybody has to choose, what's right for them. But don't fit into this category where you put everything into private equity, because it would be way too risky and way too volatile, obviously. So now coming to fintech investments specifically, or investing in fintech startups, how do you select and how do you choose which startups to back? What are you looking for, Malika?
Okay. I think this basically comes down to your own experience and the experience of people you trust and know how they think in your angel investor network. So one, you should have a network. Two, you have to do your own research. You can blindly follow people if you know them very well, but for yourself. So what I look at is it's very much like dating. Don't marry the first person you come across. That's probably what we would say to our children if they were getting married. So what I see, and I see this in myself as well. So I look at the equity analysis space, where there's a lot of software coming on board now that takes all the information on all the 10Ks and annual reports and puts it out there in some way that you can access much easier than you used to be able to. And so the first startup I came across was by a Facebook founder. It was very powerful. I could see people were getting on it, but they had no cash flows. And then like a year or two later, I found my investment managers were getting on this platform called Sentio, which was, again, very well founded. I'd never heard of the founders though. So I was like, oh, that's it. And then I came on Suzanne's network and found two other guys who I'd never heard of. They're very young, but they had a bunch of banks backing them onto this equity net on this. So it means the banks would buy that research once they generated it. And then lo and behold, 3 months later, I found another startup doing the same thing. So I think choose your subsectors and then do your research as you go along. And I think there is no magic formula as to team. Like the best team sometimes doesn't win, the best technology sometimes doesn't win. And you've seen that, I've seen that from my Silicon Valley days. Like it's very hard to make these choices. So what I would say is date heavily, like, you know, in your choose subsectors. Like obviously certain subsectors in fintech, like payments, is going to work, but don't put your money in the first one that comes around. Look at it carefully. And I know there's always time pressure, but it's fine to just back a number of players in a certain subsector, which is exactly what professional venture capitalists do. That would be my 2 cents.
Fantastic, Malika. And FinTech Circle, you know, we when we choose FinTech in startups, you know, as deal flow for investors, we choose them in various ways. You know, one is applying on our website, you know, for FinTech startups who apply to us, equally as FinTech investors apply to us, and then we choose, you know, whom we invite to join us. And for startups, they also go through selection days where they pitch and present to our jury. And you are a member of our jury, Malika. So could you explain how these selection days work?
Yeah, so I very much enjoy the selection days. I think there's a couple a year, and it's all day. So it's a big commitment from any individual to give up their time for 2 whole days. And I'm always surprised when I come on and I see so many people with you have a great panel there, Suzanne, so congratulations. And they give you a lot of their time. And why do I come on? Why do I do that? It's because I sound very smart somewhere else because I suddenly know what's coming on board. I think because you're fintech dedicated, a lot of people come to you and then they give these presentations. And then we chat at the end of the day and try and select what the best ones were depending on a number of criteria. So you might or might not like the founders and how they spoke, but then someone else might come up with a different perspective because they might know that founder. I only know, you know, little bits of different pieces of finance. I know a lot about them. For example, the last FinTech Circle, I think there was some invoice financing. I know nothing about that. But one of your panelists knew, you know, he'd worked in that for 20 years, so he knew a lot. So I was just listening to him. So I think there's a lot of cross-pollination, and I call it a multidisciplinary team effort where everyone's bringing in different, you have the technologists, you have the marketing people, the salespeople, different areas, and I think that becomes very powerful. And then we have a scoring system, and I think you've gone away from a very specific scoring to a more general scoring and opinion-based scoring, which I think is really good because it's funny how I think I'm always amazed at the end how so many of us, even though we're from different backgrounds, will score the companies in the same order. And Suzanne, you've had a couple of exits and things like that, so you can see that that system does work. Like people are, you might come from 2 different backgrounds, but the way the founders, the way you react to the founders, the way you react to technology is similar, and there's usually not much disagreement between us. I think that's also interesting. You know, there might be like the clear winner is always the winner, and then some people are just like, why, you know, why are you? It's very clear that they might not have a valid proposition. So I think you do a very good job of separating the wheat from the chaff in this in looking at these startups at very early stages.
Yes, no, thank you, Malika. And selection days are important because we try to do the hard work for our investors as well at the end of the day, like you said. And I think you also mentioned you're part of the Stanford University's Angel Investment Committee. You know, when you choose angel investments for Stanford University's Angel Network. And so you're part of 2 investor networks, you know, FinTech Circle, Stanford's. And how and why do you think is it important to be part of a network versus doing it on your own?
Okay, it's the multidisciplinary team. Like when you are, so founders are the most confident. To be a startup founder, you have to be extremely confident, extremely sure of yourself. You know, almost megalomaniac mania in your belief in your idea, because it's so hard. And I admire people who do it. But because they believe it so heavily, I think it's very easy for each of us to believe in it very easily as well. So the only protection you have is to have other people who know the area much better. Like, so if you know a certain area, if you know a certain subsector, please go ahead and invest in it. But there's so many subsectors just within FinTech Circle. And I should just say that what I see, so with Stanford, I'm involved in the UK networks, not the general, there's other ones, but I'm specifically involved in the UK ones. And we have things coming from right and left. We have food startups and recycling startups and, AI and design of some sort of new recycling plastic and things like it. It's all over the place. And it's quite fun because, in that network, there are people who know different things. And what I like about FinTech Circle is, I think it's, finance is going to change. Between 2021 and 2030, our industry is going to revolutionize, and it is going to be fintech that takes it forward. And there are going to be a lot of winners and a lot of losers. And in terms of startups, and the banks and the large asset managers are just not able to innovate. So they're going to come from this pool that we are looking at. And so I like the specificity of it, where one minute you're not looking at a clothing startup, like a Boohoo lookalike, and then the next one, some sort of new Facebook platform kind of thing, social media thing, and then seeing a fintech one. You're seeing just fintech ones, and usually you're over the selection days, you see ones that look very much alike, and then you get to pick on the founder or the team or the technology. And the traction they have. So I like that about it.
Yes, that's great. Very helpful, Malika. And I think now what I would love to do is, after we talked about the overall structure of investing, spreading your money across different asset classes, don't put all your eggs in one basket, choosing well, leveraging the knowledge, the expertise of fellow investors, before you make a decision. I would love to talk now a little bit about the taxes and the tax situation. This is specifically now for those of you who are working, living in the United Kingdom, and have an income. For those of you who have got an income in the UK, there are huge tax advantages by the UK government to support companies in the UK raise seed stage money. And so I wanted to ask, our experts, if I could come to you now to ask, because everybody talks about these acronyms, SEIS, EIS. So maybe let's start with SEIS first. Can you explain what this actually stands for, what it means, and why it is such an attractive tax benefit for investors?
Yes, I can. So basically, the Enterprise Investment Scheme, EIS, has been with us for quite a few years. And probably in the last 10 years, the Seed EIS Investment Scheme, which is basically the smaller brother of EIS, came around. The rules or the legislation is quite complicated for both, but they're virtually mirror images of each other. So you might hear people mix and match the terms EIS, Seed, EIS, but the main things are the reliefs that are available, the different tax reliefs that are available under each scheme. So to start with the Seed EIS scheme, this is a tax relief that is aimed at sort of small startup companies. The company must be pretty new. It shouldn't have been trading for more than 2 years, and it must be carrying on or preparing to carry on a qualifying trade. Now, just to give you an idea of the size of the company, it can't have more than 25 employees, and its gross assets have to be less than £200,000. So we are looking at small startup companies, and basically it must carry out a qualifying trade to qualify. And fintech businesses quite often are developing technology, and that's quite straightforward that it should qualify. Sometimes there are excluded activities like money lending. So basically you've got to have, I suppose, your wits about you as to what the activity of the business is. But a number of fintech companies will qualify and do qualify. Now, just to go on to the CDIS reliefs, because the reliefs are targeted at high-risk sort of startup companies, the tax reliefs are very generous to sort of compensate the investor for this. For CDIS, basically you can invest up to £100,000 a year, and as Suzanne said, as long as you have a UK tax liability, you can claim the SEIS EIS tax relief against that, and the relief is 50% of the amount invested. So basically, if you make the maximum investment of £100,000, you will get a tax credit of £50,000 against your UK tax liability. Now, I suppose one of the great attractions of SEIS EIS is that if the company does really well and basically there's a big exit after you've held the shares for 3 years, that capital gain that you realize will be totally exempt from capital gains tax. So it's the 0% capital gains tax rate, which a lot of people strive to achieve. There's a further relief available at the time of investment, the reinvestment relief. So if you're already making capital gains and then you make a SEIS EIS investment, you can actually exempt some of your gain that you've realized. So if you invest 100,000, you can exempt half of that gain, which is £50,000. And assuming you would have paid 20% capital gains tax on that, you get a tax saving of £10,000. So ultimately, on the investment, if you invest 100,000, you get 50,000 income tax relief and potentially £10,000 capital gains tax relief. So overall, you're getting 60% relief on that investment. So the upfront cost of 100 is reduced to 40,000 by the application of the tax reliefs. I suppose one further point to mention from the inheritance tax purpose point of view, it's one of the taxes that most people don't think about, but because you're investing in unquoted shares, they are exempt from inheritance tax after 2 years of ownership.
It's fantastic. I mean, super benefits, for investors. And I think you said it was 50% tax benefit for SEIS, and for EIS it was 30%.
That's right. Yes. If we go through the sort of the EIS benefits, EIS is still aimed at sort of small, medium-sized companies, but they are a lot bigger than the SEIS companies. They can have up to 250 employees and gross assets of up to 16 million. So it gives you an indication of the size of company. In fact, some companies that are listed on AIM still qualify as EIS companies. But the tax reliefs on the EIS investment, compared to SEIS EIS, where you get 50% on the amount invested, with EIS you get 30% on the amount invested, but you can invest more. So you can invest £1 million each year in EIS companies and get 30% tax relief. With EIS, there isn't that CGT exemption upfront. So basically, your upfront investment cost is reduced by 30% through the tax relief. You could also, though, defer some capital gains tax. So again, if you're making capital gains, and say you have £1 million of gains and you make £1 million of EIS investments, you can defer the gains on a pound-for-pound basis. So basically, you don't pay the capital gains tax until the time that you sell your EIS shares. So there is a benefit there. If you're in the process of making gains, you can delay the payment of tax on those by making EIS investments.
That's a super interesting reminder, Gordon, because I had forgotten about that. So that's very important information, exactly, that you can defer paying capital gains tax if you have made a capital gain, but then basically decide to make an investment in a fintech company. You can then defer it, and you said up to 3 years, or?
It is. So basically, from the point you make that gain, you can either make an investment in 3 years, the next 3 years, or you can look back to see if you've made any investments in the past 2 years that would qualify. So it's quite a wide time frame that you can look to defer capital gains tax.
Fantastic. We've got lots of questions coming in while you were both speaking, Gordon and Malika. So I will just read you out those questions now. And I will also, so thank you very much for our audience for being so engaged already. So you can just type them into the Q&A box on the right. So the first question, if I maybe go to Ian Bushell, thank you very much, Ian. It was, is there any tax advantage to non-UK residents to invest in these UK startups? So if you're a non-UK resident, but you still get income, in the UK, Gordon, what would apply to you?
I think for the non-resident, as long as you have a UK tax liability, you can make the EIS or SEIS EIS investment and claim the tax relief against it. So it'll reduce your UK tax liability. There's no specific other clause in EIS or CDIS for non-residents other than it's a relief against your UK tax liability. I think you'll also, for capital gains tax purpose, have to consider where the person is resident, because although the UK legislation says that your gain will be exempt from capital gains tax, you'd have to check in the country that the investor is resident for that exit position.
Makes sense. And then there was a follow-up question, was for startups, because of course the investors get this tax benefit. So do startups also get a tax benefit specifically here for research and development credits? How does this work? I don't know, Gordon, if it's also an area you're working on.
I must admit, R&D tax credits isn't one of my speciality points, but there's a whole load of tax reliefs available in the UK for a wide range of companies, and your startup company should qualify for R&D tax credits. There's also tax advantaged share schemes to the EMI scheme, which will incentivize employees. So there's a whole range of tax reliefs to incentivize investors, to incentivize the company, and to incentivize employees.
Excellent, and very good. So definitely there are lots of, I can say that just to Ian, there are companies out there, accounting companies as well, there who specifically help startups to claim back research and development costs. So there's lots of opportunity to do that, and it's very beneficial for startups, obviously, to do that, and can lead to very nice rebates. So now let me go to Arjene's question. So Arjene Maslow, thank you very much for your question. And she had a question for Malika. She said, Malika mentioned payments as a promising subsector. What is the view of the panel on the SME finance segment of FinTech? Maybe Malika, if you want to go first, then I can add my thoughts as well.
Yes, I can start. The reason I mentioned payments is because there's so much activity going on in there that you see so many people with very, very similar propositions, and they're all going after this very large market share. It's I guess skinning it down to SME would be a good idea, but I think, Suzanne, you'd be much more in terms of actually pinpointing investments. You'd have much more knowledge than I would.
I would say, Arjene, in terms of the SME finance sector, is a huge growing segment. And the reason why it is such a growing segment is because it has been in the history often ignored, by banks, because SMEs were not big enough to make sense, for banks to target small SMEs, where they could target large companies. It's much more profitable, for a large bank to go after large accounts than small SMEs. And so there are lots of fintech companies who focus on the SME finance sector, and it's a booming sector. So we see lots of activity there, great fintech companies developing solutions for SME finance. So a very interesting space, lots of things happening already. So it's aware of, definitely the competitive landscape before you decide to invest in, but I think it's a growing space which will be hugely important in the future. So definitely I would say yes, SME finance is a very hot, very interesting area to invest in. I would like, Gordon, just to come back to you. You explained basically SEIS benefits, with 50% tax relief, EIS for 30% tax relief, and no limits to the upside. There's no capital gains tax to pay, there's no inheritance tax to pay, which is an incredible advantage when you think about how much people have to pay in inheritance tax often. So those things are huge. And what about the downside? Is your downside also protected to some extent? It is already with a tax advantage, but if the company would go bust, for example, or what is there any downside protection in addition to what you said?
Yeah, there is, because quite a few startup companies don't make it, so investors do suffer losses. So in the UK again, there's tax relief against income. So if you'd invested £100,000, say, in one of these companies, and you'd had your 50% tax relief, so you've still basically got a £50,000 investment, if you like, in that company. When the company does go bust, you have to look at the exact legislation and check that all the rules are met. But broadly, you get another slice of, or another chance to get tax relief, because the £50,000 that you haven't had any tax relief on, you can claim against your income. and you get that at your highest rate. So if you're a 40% taxpayer or 45% taxpayer, you get a deduction from your income tax liability, 40 or 45% of that balance of 50,000. So yes, there is protection against the downside. Sometimes the numbers get a bit tricky or complicated to work out the reliefs. So it's probably, for the first time, it's probably best to sort of ask an advisor. But I know a lot of angel investors, once they get going, they get to know the rules just as well as us, so can manage it themselves.
Yes, that's fantastic, Gordon. And from a practical point of view, so let's assume, you're a new fintech investor, you made your first investment in a fintech startup, you get told, that it's an SEIS or EIS investment, and the company then needs to issue you a document. Can you tell us about, what's the document, or what are the steps in practical terms, the investor needs to do in order to claim back the tax?
Yeah, that's a really good question, because the investor, obviously wants a bit of security from the company that their investment's going to qualify. And as an investor, I'd be asking the company if they'd done an advance assurance, which basically is a letter to the HMRC in advance of the fundraising round, which gets a provisional approval that the company and the trade and the proposed fundraising will qualify. So I think that's the first thing I'd be looking for as an investor, just to see if there's an advance assurance. And as you said, Suzanne, assuming they've got that and you subscribe for your shares. The thing about CDIS and EIS is you have to subscribe for shares. So you pay your cash and you get shares. You can't convert loans. That won't qualify for EIS. It has to be a set method of acquiring the shares. So once you've subscribed for the shares, the company then has a responsibility to go to the revenue formally and say, we've issued these shares. We're proposing that they're either CDIS or EIS, and basically submit the relevant forms. It's basically an EIS1 form or a CDIS1 form. The revenue then process the documents, hopefully don't have any questions, and then they issue a certificate to the company and issue a statement to give to the investor called the compliance certificate. And the investor then has this compliance certificate, and once you've got that in your hands, you're able to claim the tax reliefs either through a self-assessment tax return or by getting the tax reliefs put in your tax code for the year.
Great, that's very helpful, Gordon. We also have got another question coming in from Günther Schmidberge. And Günther asked, what about investments in fintech startups in Africa and in Europe? Do they also get tax relief? Maybe if I start out and then anybody else who wants to comment on that. So my experience, Günther, is that actually I'm Austrian, so I'm from Austria originally and live in London since 25 years. So this is one question I asked as well, because I also invested in a European fintech company, and it depends per country. So other countries also have got tax benefits. However, I must say I've never seen one which is as attractive as the UK tax benefit, where you get this enormous tax benefits here in the UK for investing in fintech or in tech, in startups in general. I've not seen it in any other country I looked at, unfortunately. And I think it's something which other countries should do as well, because it helps, the startup community to grow, very importantly. But I've not seen that yet. And I know there are many countries who've got tax benefits, but they're normally less, than what we've seen here. But it's very important to always ask. And normally the startups in those countries know about those terms. So that's the best thing, is to ask them what they can share with you as an investor, so that you are aware of that and that you can apply, for the right schemes. But is there anything else Gordon or Malika or Deborah want to add?
I'd agree with what you said there, Suzanne. Just a bit of a story from the past. Myself and one of my colleagues met the Dutch Ministry of Finance probably in the last 5 years, once to talk about the CDIS scheme, because they were thinking about introducing something similar. I must admit, I don't know how that went. I've not heard anything that it was introduced, but they were thinking about it, because the whole thing about CDIS and EIS, they're approved EU state aids. Obviously, things have changed since we left the EU, but that, it had to be approved by the EU. So I would have thought that they could have tried to do it in other countries, but as you said, not as beneficial. And I suppose just another point to that is, basically, if the company is operating outside the UK, they can still sometimes qualify for these reliefs if they have a permanent establishment in the UK. So this is where the structuring gets a bit tricky. But if there is a proper place of business in the UK, but you're doing something, in Africa or somewhere in the EU, there's still a chance it could qualify, but it just depends on what the trade is and what the actual presence in the UK is.
Yes, that's a very important point, Gordon. We've seen that several times, that companies who have got one limited entity or company, set up in Europe, then they set up a second company in London, in the UK, in order to qualify for those tax reliefs for investors, because they also want to expand into the UK or want to attract UK investors as well. So we have definitely seen that. That's one way to do it if it fits, if it fits to the company strategy and to the investor base. But that's really helpful, Gordon. Thank you so much for shedding more light on EIS and SEIS, and how those schemes work. What I would love to do now, Deborah, is to come to you to talk about growth of companies, and specifically, once the investment has been made, what influence will investors have over the operation of the company?
Okay, investors, they won't have influence over day-to-day business operations, but the company's shareholders agreement should provide that before a company can carry out sort of key decisions, that it must obtain the approval of a majority of its investors. So investors effectively have a veto over key matters, and key matters are likely to be things like issuing new shares, raising new money, borrowing money, selling the business. Similarly, the investors won't control the board of directors, but they may have a representative on the board or a less formal non-voting observer. So that allows them to keep up to date on business operations. And another way people keep up to date is even if there's no investor, director or observer, the investment documents are likely to provide for the investors to get regular status updates. So that could be by way of delivery of monthly management accounts, quarterly financial summaries. At the very least, you get annual accounts. So whilst that doesn't equate to influence, it does mean the investors keep up to date on that financial status of the company, which is, key.
Exactly, that's so important, and investors want to see that, because that's, it depends if you're an active or a passive investor. An angel investor can be both. We've seen angel investors who are very actively involved. They want to be able to help anytime. They want to support the startups, with their expertise, their growth, knowledge, how to scale up, and their contacts. And then, of course, there are more passive investors who invest in so many fintech startups that they don't have time to spend so much time with each of those companies unless it is really needed. If a company has difficulties, to support them in those more difficult times. But it's really so very important to have communication. I think that's a key thing, to have
communication. And if you're going to be a passive investor, then having those key veto powers just over, material decisions, so you're at least informed when there's a big event going on.
Yes. And I must say, my own experience as investor is, the better the communication, the better the governance, the faster you can help if it's needed.
Yes, exactly.
That's so important. We had one company which had difficulties because of co-founder conflict. And because we were having these literally monthly meetings, we could immediately help and come to the support, of the CEO. But other companies where we don't hear anything for 6 months, we just don't know what goes on, So that's then more difficult than to support, and that's very important, because investors want to be told what goes on, and they just don't want to be informed when a new fundraising starts. It's very important for investors to ask, for updates and get that from the best fintech companies. And another question we often get, Deborah, is if the business fails, will investors have any liability?
Assuming the investor was just a shareholder, then in the event of a company failing, then no, the shareholder would only lose the money they put in. It's really in the name. So a limited company means a shareholder has that limited liability for the debts of the company. So they'll lose the value of the shares, but otherwise they won't have any further liability to contribute to the assets of the company.
Excellent. So that's really important. Again, for anybody who wants to have a certainty that they are not liable if the company goes bust, of course they're not if it's a limited liability company. Exactly. Deborah, the other thing I wanted to ask you is, investors who are, let's say, on a growth unicorn. So if you invested in a large growing companies, they're becoming, bigger and bigger and more successful. Could they be forced to sell at any stage to sell their shares?
So there's often in the company's articles a provision called a Dragalong Provision. And this provides that if shareholders, which of course would include the investors, owning more than a certain percentage, which normally is around 60 to 75%, if they want to sell their shares, typically because they have an acquisition offer coming in, then a majority can force all the other shareholders to sell their shares. And the reason a company would always have this in there is it protects all the shareholders really from, say, having that one small stubborn shareholder that refuses to sell when there's an acquisition offer, and they could block a deal for everyone. But like I say, that percentage is there to protect the investors, because it's only if a good percentage of everyone wants to sell that they can then use that quite draconian provision of making everyone sell. And also there's often sort of smaller provisions in the articles. So if a shareholder went bankrupt, for instance, they often will put in a provision that says you'll have to sell your shares in that case, because they don't want those shares to go to a trustee in bankruptcy. They'll want them to be offered to the existing shareholders instead.
Yes, I think very important terms, and we see them in all agreements, all term sheets in investments, because it like you said, it's a benefit for investors. In fact, that if there's a good offer and good exit, that all shareholders get the same valuation, get the same price when they sell their shares. That's not one person could stop the whole exit from happening. And so that's a key term which actually is beneficial, beneficial
Yes.
to small shareholders and small angel investors as well. And also the other question I had for you, Deborah, was, in the company, if the company needs more financing, and we as angel investors, we invest early stage. So we invest, our private money, our private savings. And at some stage, we won't be able to follow on anymore, because it's when the VCs come in, or private equity at a later stage. So could a private investor be forced to follow on, or to invest more at a later stage?
Simply no, they're not required to put more money in. There obviously is a but in that, if you do have the funds to do so, you may wish to, because obviously that will maintain your shareholding percentage. Because if there is a further funding round and the VCs come involved and you don't invest, then you're going to be diluted. So for instance, your 4% would go down to 2%. But obviously they can't force you. So it'll just be your shareholding will decrease. But you've got a smaller piece, but of a bigger pie now. So.
Exactly. So very important as well, for our new investors. So when you invest in a startup, as a new investor, you don't have to worry about being liable if the company goes down. You can't be forced to invest more than what you invest in the first round if you don't want or can't follow on. That's very important. Safeguards, for private investors. Deborah, thank you. Very useful, very helpful explanations. I just go back to our Q&A box on the right side. So please feel free to ask us more questions. And I know some of you also submitted questions prior to this webinar on Eventbrite. So I just go through those here. And the first one we got here was, how do you decide which startups to support with angel funding? So what are your decision criteria before you invest in a startup? Maybe Malika, if I could ask you that, just to summarize.
Sure. I think the thing is to professionalize your investing. So have a checklist of things you look for. One is the technology, but be aware that not the best technology wins every time. The second thing is the founding team. Have they worked together before? Have they looked at have they had other exits? What is their experience? Do they really know the sector very well? The third thing is, what are they focused on? So most founders are very focused on fundraising. So they will advertise on LinkedIn, I raised X amount of money, but that doesn't really get you anywhere. So the second thing they'll focus on is sales. So they'll burn cash in order to have sales, which basically, if you give out enough, people will buy your thing, but is that sustainable? And the third thing is the exit. So I would say look for people who are, they have to focus on the other two things, obviously, but look for people who are focused on the exit. So I would say try to go from being an amateur investor to a professional investor. What do professional investors do? They get professional advice. I wouldn't go file accounts without asking proper accountants. So don't do startup investing without looking for people who have been doing this for a while. And people always talk about cocktail party investing, like, oh, I got this idea at a cocktail party and this mythical, I invested in, it was Google. But I don't know. I think I know enough that that's never true. People know each other for a long time before they invest together. Opportunities come your way because you know other people, not as a single person. So I would say professionalize and expand your network of people who've done this before.
Yes, very important advice as an investor to take one's time and take your time, in your due diligence process, and choose wisely and follow those criteria which Malika said. We got another question from an investor, and he said, "How can you perform due diligence on the co-founders?" And maybe I can start, Malika, and then anybody else who wants to comment on that. Due diligence on the founding team is, of course, very important. And it was very funny because just before our webinar now, I had another webinar with a team of entrepreneurs where we talked about their fundraising journey. And I said to them that until last year, most investors would not have invested in startups without meeting the founders in person, because we were all, reliant on meeting the founders in person to get a feel, and see if the chemistry works, but also to get to know and to get comfortable that the founder will be responsible and has got the passion and the drive to succeed. Now, after 1 year of Zoom calls, investors are used to invest in startups without ever meeting them in person, because it's not possible. It hasn't been possible so far. And so how do you evaluate co-founders? How do you evaluate the team? That's a very important question. And there are, of course, many ways of doing that. One is simply social media search. Google search is one key thing. The other one is that there are specialized companies out there who do searches, on individuals. It can be because of KYC reasons, know your customer, know your anti-money laundering. So you just want to check out, the people who are behind the company. And so these are, the various options depending, which way to go. I mean, some people have detectives, they go down, but it's normally large corporate deals, where they really go down and look at the whole past history, of the founders before they invest, just to make sure that everything is correct and proper. And I would say, if for those of you who work with entrepreneurs who are looking for co-founders, that's another angle, because of course, if a CEO of a fintech company, often, sometimes they are either techies or they are business people, but they're looking for the opposite co-founder. The business people look for a technology CTO or co-founder, and vice versa. So how do they find the best co-founders? And again, it's not often easy, especially now where you can't meet in person, to make sure that you find the right co-founders. But the decision how to do that is so important, because one of the biggest conflicts which can occur in startups is founder conflict. And founder conflict, as an investor, is very difficult to deal with if the founders fall apart and don't get along anymore well, but everybody owns 50% equity, or maybe 40% equity, and the investors own 20%. So that's something which is very important, I think, as an assessment criteria. Coming back to the question which I asked Malika, how do you choose which fintech companies to invest in? It's very important to check out, do the founders get along? Do they get along? Do they have, do they work well together? And will this hopefully continue as much as you can, from the outside? So that's, answering two questions in one. So now let me go on to another question here, which we have got received from Francis Makinva. And Francis says, how do I know a business is right for an angel group investment? So I would say to Francis, if a fintech company wants to apply to FinTech Circle to fundraise through our investor network, the best way to find out is literally to apply. You can apply, if you're an entrepreneur, you could apply at fintechcircle.com, apply for startups, and then you submit the investor pitch deck. You submit a 3-minute elevator pitch video, which is recorded by founders on their mobile phones, and also to complete our questionnaire, which then allows us to systematically compare all applications. And based on this application process, then FinTech Circle selects the best, normally the best 16 companies out of 60 plus, applications. And those 16 companies come to our selection days, which Malika described, which are 2-day events, where we've got a jury of investors helping me and helping, my team to decide who the best investment opportunities are. And then what we do is we invite those 50% of fintech companies to a coaching day. And at this coaching day, that's again another 1-day event where we coach each team to help them present in the best possible way to investors. And that's very important, because if you've never presented to investors before, it's difficult, and equally for us investors, because we need to know certain things before we can make an investment decision. And if a company founder doesn't know those things and invests and talks about other things, if it's an angel investor pitch where you only have got 7 minutes, you waste your time. So it's very important, for startup founders to learn how to present well to investors, so that investors get the best information they need out before they can make a decision. So that's our coaching phase, and then our investor network. And I can just see my team. So my team has just shared here with all of you the link where you can get information on that. So on our website, you see it now published, the link how to submit your application, if you're an entrepreneur, to submit your funding application to FinTech Circle, but also when you're an investor, how to apply to become a fintech investor in our angel investor network. So you've got both links published for you here. So that's important. I wanted to just go back to another question we had gotten before from our attendees. And the question was, I think Malika, you responded to it before, but what percentage of a balanced portfolio should you invest in startups? Maybe you can just summarize your conclusion here.
Okay, I think anywhere between 5 and 20%. I think I'd settle at 10%. If you're a high net worth, don't put in any money you can't afford to lose. Understand that this is a long-term 3 to 5 year investment process. Look at how low can your investment go. So if you put your money into the S&P 500 or the FTSE 250, the chance your money can go to zero is not very high. Even you might have dips, massive dips, but it's not very high. If you put it into real estate in London, the chance of it going down to zero is also very low. But if you put it into startups, it is there's a good chance it might go to zero, but obviously we have the tax benefits, but we have to think about that. On the other hand, the chance that the S&P 500 will double in the next 3 to 5 years, next to zero. The chance that even London real estate will double in the next 3 to 5 years, almost zero. Whereas a startup, if you pick the right one, you might make 10x or 50x or higher. And I would just say be very, very practical about who you are as an investor, because as I said, founders have dreams, and if you're trying to go after someone who's like Elon Musk or Peter Thiel, who's really trying to change the world, a lot of people believe they can, but they can't. But it might be more practical to choose a founder who's going after a certain niche, is pretty sure they can do it, and is going to maybe double, triple, 5 times your money, maybe not 100 times it. Pick according to who you are and what your network is like.
Fantastic, Malika. And I think we're coming to the end of our webinar. I know that we have not answered all questions, but any of our investors, on the call, any of our attendees, if we have not answered your question, please feel free to reach out to us all, on LinkedIn or at FinTech Circle. And I would love now, first of all, to thank my panelists, for your amazing contributions. So thank you very much to Deborah Angel, to Malika Pauloage, and to Gordon Rowell for being with me today at this webinar. I also would like to thank all our guests, our attendees, our investors, and new investors, who want to learn more, for joining us today. And hopefully you learned a lot and learned, both sides of the coin. Very importantly, to know the whole spectrum of investing opportunities, and also know what you need to be aware of, to make the best choices for yourself. So thank you all very much for joining us. I wish you a wonderful day. Take care. Bye-bye.